Kevin asked me to talk about mining regulation. It's obviously a very broad topic. Sorry, I better keep an eye on the time. It's a very broad topic. I'm going to focus on a couple of areas, and I'll focus on the couple of areas that I know best. And what I'm going to talk about are areas that are reasonably current in South Africa, but I'm also going to try and take a global perspective of these things, because I think it's sometimes we get so caught up with our situation in South Africa that we don't always look at what is different and unique to our situation, and where are we actually part of a broader international set of trends. The areas I'm going to cover are, firstly, I'll cover briefly the question of tax structures. Secondly, questions of ownership, which I gather was discussed a little bit in some meeting last week. And finally, social issues and the regulation of social issues and companies, and particular mining companies, issues in that regard. The interesting thing about tax structures and where they differ from country to country, I think in South Africa, and actually in much of, and in pretty much all of the developed world, we have tax structures that are consistent and the same for every company, whatever it does, and to the extent that it's in the same industry wherever it is. So in South Africa, for example, we do have a common corporate tax rate for all companies, except of course for gold mining, which historically has had a separate tax system. We have a royalty system where every mining company pays the same royalty rate, or at least every mining company mining the same mineral, although there are some differences between minerals in terms of the Royalties Act that came into effect in South Africa in 2009. And that in most countries, in fact, one doesn't even have those kinds of differentials. What has developed in countries that became mining countries, at least in the market economy, since the early 1990s, which applies to large parts of the developing world, particularly in Africa, or in other parts of Africa, and South America, parts of Asia, is a system where each company will sign a particular individual contract with the state, which sets out the terms of the way the company is going to operate, and in particular in terms of the way it's going to pay taxes and how much in taxes it is going to pay. These are called variously mining development agreements, as I think is the case in Tanzania, where Anglogold, Ashanti is concerned, or stability agreements, as it's called in Ghana, another place where Anglogold Ashanti operates. And what it does is it sets out exactly what tax rate the company is going to pay, what royalty rate the company is going to pay, the basis of it. And what that creates is a situation where different companies doing the same work may be paying different amounts to the state. Historically, why did this happen? Part of it, I think, is in the clue. Is you're given a clue in the term stability agreement. In the early days, at least, from the mid 1990s, when countries that were previously not open to private investment opened up, the investors themselves were looking for some kind of contractual certainty. for what they would be facing in the times ahead. It's something that did facilitate a whole lot of mining investment in particularly countries that were previously run by socialist or communist governments. But it obviously also causes complications. First of all, because it means that when different companies are paying different tax or royalty rates, it raises questions and eyebrows. And obviously no one wants to pay more than anyone else. What that has led to in certain countries is a desire by governments to keep those agreements confidential. That has proven to be a very negative thing, particularly we have found as Anglogold. It's a difficult thing in relation to relationships with those the civil societies of those countries, because the assumption is that if something is confidential, there must be something to hide, which frankly there isn't anything to hide, but what those governments are seeking to do is to prevent companies finding out about each other and then trying to negotiate downwards, as it were. Anyway, that I think is one of the more interesting things about the different tax rates. Let's talk about ownership. There has, as anyone who reads newspapers or listens to the radio or television or reads websites will know, quite a lot of robust discourse in South Africa over the last few years over the question of nationalisation and all that. The original ANC Youth League proposal actually never actually was calling for full-scale total nationalisation of any companies, but rather some kind of partial state ownership thereof. Although it wasn't particularly clearly articulated. However, I did a little bit of research in preparing for this and discovered that of the 10 countries where Anglogold Ashanti operates mines, plus the 2 countries where we have the largest exploration activities. And let me just, I should have perhaps done this right at the beginning, told you a little bit about where we do operate. South Africa, of course, and going northwards, Namibia, Tanzania, Ghana, Mali, Guinea, in Africa, Brazil and Argentina in South America, and also in South America we have a large exploration operation in Colombia, as we do incidentally in the DRC in Africa, and then we also have operations in Australia and in the United States. Anyway, of those 12 jurisdictions, in 5 of them, the state, in one form or another, holds a share of the operations that we carry out. So, for example, in Argentina, the state government of Formicruz, which is the state in which our mine there is located, has a 7.5% share of our operation. In Ghana, the state has historically had a 20% share in mining operations, and when Anglogold and Ashanti went into a business combination transaction in 2004, that translated into a government holding in the main Anglogold Ashanti stock of around 3%, 3-point-something%. In Guinea, the state owns 15% of our operation there. In Mali, it's 20%. Generally, with 1 or 2 exceptions, but still around that. And our Mongwelu exploration site in the Democratic Republic of Congo is 13.78%. I don't know why that strange percentage, but it is. So state ownership is, and in these cases, it's other than Ghana, where it's a simple state ownership of Anglogold Ashanti shares. It really is. It's a free carry. So essentially, what happens is that each local operation has a board. There would be some government representatives on those boards, and the state will receive a proportion of the dividends that flow from those operations. But what's really important, to get back to the last thing, what's really important to a mining company, is less about. One can debate whether that's a good structure, but what really is important is, in terms of international competitiveness, is what is the share of revenues that ultimately flow to the state, whether it be in the forms of dividends due to their ownership, or corporate taxes, or or royalties. That really is the key point that will concern a company and determine how willing it is to, and one of the key factors that will determine how willing it is to invest in a particular country. The other, obviously, would be calculations on how lucrative the ore deposit is and how much profit there is to be made on it before those government remittances have to be paid. Okay, and then the last main point I'm going to talk about are the social issues. Increasingly, the world of business, and mining companies in particular, are having to face up to the fact that societies expect companies to behave and act and operate in a responsible manner, in a manner that avoids or minimizes any negative impacts on communities and society as a whole. And in addition to that, take positive actions to enhance the contribution to society over and above and beyond the taxes that companies pay. And though one still gets a sprinkling of libertarians who would say that the business of business in business is business, that really isn't the case anymore. And actually, I find it a little bit surprising, just because of the pressures I know that the company I work for faces, how little interest journalists take in these issues, because they are very, very much in the forefront of the minds of the managers of companies and their shareholders. And what's been happening over the last 10 years or so is that not only is there hard law in this regard that companies are needing to adhere to, there is also what lawyers would call soft law, or just generally social expectations that companies need to take note of and bring into basically the way they operate. In South Africa, of course, we have much of this. These kinds of issues are regulated through what are called transformation instruments, be it the DTI codes of conduct for empowerment, or in the case of the mining industry, the mining charter, which came into effect in 2004 and which was reviewed in 2010. quite often one gets comments from some relatively conservative business commentators in South Africa that all of these charters and things are doing damage to investor perceptions and so on, because they're introducing new onerous conditions that companies don't face elsewhere. Well, I'm not altogether sure that that is correct. It may be the case that in some respects, in some aspects, the way that these things are implemented in South Africa are, well, could be done better and more efficiently and more effectively. But if one thinks about it, if one thinks about just to go through the pillars of the mining charter, with which I'm most familiar, employment equity is obviously a big issue in South Africa, but actually pretty much everywhere we operate, and certainly in the developing world. Obviously it's not an issue in places like Australia or the US, but certainly in every other African jurisdiction, in Colombia, in Argentina, we have a strong imperative, partly due to pressures from communities and society and governments, to maximize the amount of local employment we do and train local citizens into positions of authority. And this is particularly an issue in countries where commercial mining is relatively new, started only as I say, in the mid to late 1990s in countries like Mali, Guinea, Tanzania, where there just isn't a history of mining and training of people with the skills that mining companies and mining operations need. And there's a lot of pressure on companies to do something about that, to train and to ensure that at least a reasonable proportion of the management at operations is local people. It obviously doesn't have the same racial imperative that is the case in South Africa, but that's a consequence of South Africa's history. In principle, it's no different. The same goes for procurement, where in South Africa, yeah, there are pressures to procure from black-owned companies. Elsewhere in the world, there are pressures to procure locally from local companies. Once again, you're talking about places where mining does not have a long history and where there isn't a local infrastructure of suppliers to mining operations. And we are under pressure, and we do various things to develop local procurement. But what I'm trying to say is very similar issues we face elsewhere in the world than here. That it applies less in places like Brazil, for example, where there's a long history of mining, and also in a place like Ghana, where mining continued or has been going on for more than a century, since pretty much gold mining, since pretty much the time that it started in South Africa. Yeah. What other beneficiation, which is an imperative here. As you know, there's a lot of talk, and it was one of also the key points of discussion, or certainly a key points of the discussion paper at that little meeting at Gallagher Estate last week, which is how can the products of mining or inputs into mining be used to advance industrialization in the society generally. Surprise, exactly the same. Every government of a economy that has a large mining component is thinking exactly the same thoughts, and for very good reason, of course. And I mean, and then finally, and I think is my 20 minutes just about up, Kevin. just about. Finally, again, in the area of so-called soft law, not only must companies, the one aspect of that I haven't mentioned, but where there are similarities between South Africa and elsewhere in the world, is what is called corporate social investment, where companies go out and, in addition to the taxes they pay, make contributions to development of, for example, local economies, local social infrastructure, like, well, schools, hospitals, or whatever. That in itself is a whole topic on its own, but it's another factor. Finally, a topic, again, one of those that I'm surprised hasn't had more publicity in the world of business journalism. Last year, the United Nations Human Rights Council approved what are called the guiding principles on business and human rights, which set out a whole set of a framework and a whole set of procedures regarding how are the human rights of ordinary people protected from harm that might be caused by business. And it sets out a framework for what are the responsibilities of government, what are the responsibilities of business. And businesses have a duty to respect human rights. Governments have the duty to protect them, according to this formulation, which is basically the new Bible on business and human rights. And I'd urge you to take a look at them sometime and think about how it might apply to the work that you're doing. It happens to be a large part of the work I'm doing at the moment as well. But increasingly, shareholders are asking the managements of companies, what are you doing to observe these guiding principles? And increasingly, companies are going to have to show that they are taking real notice of it. And the basic intent is to ensure that businesses do no harm to the employees and the communities and the societies in which they operate before they even begin to start thinking about doing good. Today, that is still soft law. The day might well arrive when it becomes hard law as well. There are a lot of NGOs, for example, that are agitating for the world to move on from guidance to hard international law, in fact. Anyway, I think I'll leave it there. Hopefully we've still got enough time left for discussions, and I'm happy to take any questions that you might have.